Theophilou from Taxand. Mr. Theophilou.
Hi, Grigoria, and many thanks. Good morning, everybody. Let me also show our sympathy to our friends and colleagues that they are in Ukraine, and hopefully this catastrophic war, as Grigoria said, will end the soonest. Today we're going to be discussing about the taxation of investment funds. This is my part, and a few words about us. Taxan is the biggest tax network in the world. We have offices in around 50 countries around the world, and in some, Taxan is a tax boutique network. We deal exclusively with Taxan Cyprus, so our main line of business is tax advice, structuring, transfer pricing, and the like. Now, when it comes to investment funds, this is a typical structure that we see in practice. I don't want to take a lot of time on you. My previous colleagues, Christos and Anna, explained this very briefly. Let me go through from a tax perspective. Typically, these are the forms that Anna and Christos already discussed that Cypriot investment funds takes. Yet, the ones that shown as asterisks, they are considered as fiscally transparent vehicles, so they are not a tax subject, whereas the other ones are considered as tax opaque, and they are a tax subject and taxable in Cyprus. Now, when it comes to investment funds, there are four investment levels, typically, normally, in a large extent that we take into consideration. First is about the investor level, how the investors are taxed when they invest in an investment fund. The second is the vehicle, the fund itself, how the vehicle is taxed. Thirdly, how the investments are taxed. So you want to make an investment, how that investment will be taxed in the country at source. In a tax language, we call it at source. In an investment language, it is the investment country. And finally, the fourth level is how the fund managers are taxed when it comes to investment funds. Now, usually we follow the color of the money and how the money flows. So the first tax implication is when the investors invest their money in an investment fund, typically via equity. This does not trigger any tax implications. And then the AIF state, which usually is Cyprus, into our example, when they invest the money in the investment state, the source state, again, there is no tax implications. The main tax implications is when the money are flowing from the investment state to the fund state and then to the investor, which is step 3, 4, and 5 that we're going to see in practice. So this is the structure here. What you need to be aware, the tax events, is that at the investment state, you want to get a full deduction of, for example, your interest expense. You don't want to get any limitations on that. And you also want to reduce the withholding taxes paid from the foreign country. For example, if this is Ukraine, for the income remitted to Cyprus. When the income is received at the investment fund level, then you need to consider how that income will be taxed. Furthermore, whether there is any double tax relief. And of course, at step 4, when you are repatriate the money to the investor, whether there are any withholding taxes when you repatriate the money. And finally, at step 5, how the investors will be taxed when they receive the income. The fund manager is, we discussed this separately because it's completely isolated standalone scenario. Now, coming to Cyprus, what you need to consider is typically, from our experience, to a large extent, an AIF, if it is a hedge fund, it will have dividend income and gain of sale of shares that we typically exempt in Cyprus. So a hedge fund will not be taxable in Cyprus. Another type of income that we largely see on investment funds is interest income that will be taxed at 12.5. Yet if you invest your money as equity, then you get the notional interest deduction. So the income element part, the interest income element part, if there is any, it will be taxed effectively in 2.5%. If you have a real estate investment fund and the real estate are not situated in Cyprus, again, this fund will be taxed at zero because we do not tax in Cyprus any immovable property not situated in Cyprus. And of course, as you already know, we don't have subscription tax in Cyprus on the NAV. Although there is some discussions now in Cyprus to introduce this regime, at this point, there is no NAV taxation in Cyprus. Now, Cyprus has a very wide treaty network, so the treaties can be used in order to reduce the withholding tax paid at source at the investment level, and also any EU tax directives that can assist the withholding tax reduced to zero, which is the parent subsidiary directive and the interest royalty directive, that any interest, dividends, or royalties paid from one EU member state to another can be reduced to zero. Finally, any payments from the fund itself to the investors, it will not attract any withholding taxes because typically in Cyprus, to a large extent, we do not have withholding taxes paid to non-residents. We'll now have some exceptions. An EU tax directive, it is imposed in Cyprus. If you have any payments to non-cooperative jurisdictions, then there must be a withholding tax there. We don't expect this to have a very high impact in Cyprus. Now, turning to investment managers, the investment managers itself, if they are private clients and if they are inward expats, effectively more than 100%, if they have more than 100k of salary and active income, 50% of that income will be exempted. In case that they have a passive income and they are non-domicile, this income will also be non-taxable. Again, we exempt the sale of shares, so this is typically the same. When it comes to management fees, performance fees, or carried interest, in Cyprus we apply a flat rate of 8%, and there is an exception for if the manager will not be considered of having a PE in Cyprus when that manager is effectively managing the fund of the affiliates from Cyprus. Now, with respect to the international tax developments that we see in the last 8 years, which is massive, I will say, there's a huge, massive international tax developments. The OECD and the EU have introduced Action 2, which is hybrid mismatches, and Action 6, which is preventing treaty abuse. These two have been implemented in Cyprus via the EU EITI 1 and 2. So they impact, these two actions are largely impact the flow of money from investment funds, effectively from the investment state, where the source state, when the money are repatriated back to the fund itself. And another two very important initiatives is the EU EITI 3, the shell entities proposal, which largely impact investment funds, and Pillar 2, which is a minimum effective tax rate of 15%. Yet the Pillar 2, we don't see that it will be largely impacted on investment funds because there is an exception of entities in scope. There are investment funds, whereas for EITI 3, we see a higher impact. So let me briefly take you to the implications of EITI 3. So EITI 3 is effectively a proposal for countering shell entities with very low substance within the EU. The EU proposes a 7-step approach plus penalties. The most important are steps 1, which is the gateways, whether you are in scope or not, and steps 6, which are the tax consequences. Let me go through the gateways, which is the most important. The gateway tests are 3 tests, 3 gateways that you need to meet them cumulatively. So if you have an investment fund, and let me say at this point that the issue with the shell directive is not the fund itself, because the fund itself is outside the scope of the shell directive. However, the various SPVs below the fund will be in scope. Now, those SPVs, we expect that to be in scope because they will definitely meet Gateway 1 and 2. So Gateway 1 is that if the majority of your revenue, more than 75%, is coming from relevant income. Relevant income is largely passive income like dividends, interest, and royalties. However, you included almost everything there, like crypto income, immovable property, movable property, and the like. So it's a very large, widely defined, and this applies for the preceding two tax years. It's very important this because the directives we expect this to come into force in 2024. So the preceding two tax years, it means that this counts from 2022 that we are currently living. Now the second gateway, which again it will most probably apply, is that if your foreign assets are located abroad and you have a cross-border income, which is this is the case. So 1 and 2, it will be largely met. The biggest and controversial issue when it comes to EITI is effectively Gateway 3. It says that if in the preceding two tax years you have partly outsourced both your day-to-day activities and your decision-making functions, and the EITI, the draft directive, specifically mentions trust and service providers, so they want to counteract and limit their actions and the way they are doing business. So to a large extent, if you partly outsource your activities to trust and service providers, this will mean that you will not pass Gateway 3 and you will be in scope. Of course, if you have any questions, feel free to post them in your chat box or send us an email in respect of tax. It will be our pleasure to assist you. Thanks for being for taking the time, and let me hand over back to Grigoria for our next presenter.
Thank you, Christos. Thank you for being